Welcome to the weekly update, where we'll go over the action in the market for the week of May 2nd through May 6th, and then we'll look to see how things are for the week of May 9th through May 13th. This is being prepared Sunday, May 8th. Let's go ahead and look at the week's session in review. We had a really volatile week. There was a continuation of the concerns over earnings disappointments. Even if companies came out with just a stellar report, a lot of times we would see sell-offs. Once a company issues an earnings report, they also have future guidance or future projections. And depending on what is said in a big conference call, that may take the stock lower or higher. Well, what we're seeing a lot now is real concerns about future growth. Even if a company comes out with a really strong report, a lot of times you'll see a sell-off. You'll especially see a sell-off if a company's stock keeps going up until that report is released, and it's more of a buy the rumor, sell the news kind of a thing. And we saw that also take place in the market in general when it came to the Fed announcement this week. That's very common, and that seems to be happening quite a bit. Some earnings reports come out and actually have a positive influence on the market. Others come out that look pretty good, but still are seen as a disappointment. So it just kind of goes from report to report as to what influence that earnings report may have, if any. The real concern now is slowing future growth. And of course, inflation is the big key right now. And then in this past week, as I mentioned, the Fed came out with raising interest rates, and there's a lot of uncertainty about what's that going to do to the economy. For the week, the S&P was down 0.21%, and you'd never think that by just going through each day this week. We had some monster up days, some monster down days. When everything was done, we were just down less than 0.25%. Volume for the week was above average, and what we're fixated on right now are the technicals, and they're pretty much negative across the board looking at the weekly charts. The real concerns, as I've stated, are inflation and interest rates. Of course, the geopolitical concerns that are happening, Russia, Ukraine, and all of that, and that could explode either positive or negative at any time. We still have the supply chain issues that are plaguing the U.S. economy, but now we have more lockdowns in China that continue to go on. And what's that going to do to their economy? Because we buy a lot of things from China, and is that going to affect things in the U.S. economy? Oil, it's not acting really crazy right now, but it's still very high and causing a lot of concern. And of course, any kind of Fed speak that comes out. Now, the Fed made some statements in the past week. There was a press conference and so forth. But from time to time, they'll do interviews, they'll do speeches, and these people are followed around very heavily. People listen to what they say and then try to read some secret meaning into things. And then, of course, we have the continuation of earnings. As far as our trend on a weekly chart, we do have a strengthening trend, and it is negative overall. As expected, the Fed came out this past week on Wednesday and raised the Fed funds rate to 0.75%. Now, some people are saying, wait a minute, okay, just a few months ago, we were at 0. Actually, that's a range. We were at 0 to 0.25%. Then they raised them 25 basis points, so we were at 25 to 50. Now they raised it again, and we are at 0.75 to 1% in that range. Some people are really concerned about that because the official inflation report has said that we are at 8.5% inflation. If you go back to ways that inflation was measured back in the 1980s and 1990s, we're at anywhere from 11% all the way up to over 17% inflation. So is raising interest rates even going to have that much of a difference? Will it also slow down economic growth, which is typically what will happen when rates are raised? And so you have these two competing factors right now. You have the Fed raising interest rates, but if they go too far too fast in a way that can slow down the economy, then that could really hurt things and send us into a recession. Or because inflation is so high, something needs to be done to try to bring down the inflation rate. One of the things that the markets were really nervous about before the Fed made their announcement on Wednesday was there was talk of them raising interest rates 0.75% at the meeting. They raised the rate by 0.5%. We had been at 0.25. Then they raised it 0.5%, so now we're at 0.75 overall. But at the press conference that it takes place after the Fed meeting, Chairman Powell came out and said, no, we're not really planning on doing that. So that seemed to really put the markets at ease. What happened was on Wednesday, we saw a massive rally. The only problem with that is there was no follow through. We gave all of that back on Thursday and then some. And then on Friday, we continued to decline in a really choppy session. Once everything was said and done, we really didn't move all that much. Here's the intraday chart where each bar is 10 minutes, and right in about the middle is Monday, where we kind of spiked up and then ended up going lower on Monday. We did see a nice recovery going into the close on Monday. We were able to have a little bit of a rebound on Tuesday, but it was pretty much flat. And then Wednesday, that's when the Fed came out and made their announcement. We saw it gap lower and then pretty much kind of chop sideways in pretty quiet fashion. After the announcement came out, this is when the markets really took off, and we saw a really broad-based, strong advance on that day. Well, then Thursday rolls around, we gapped lower and just shot down to the low of the previous day. We broke even below that, and we ended up closing right at the low. Then on Friday, it was more choppy. We gapped lower. We tried to get back up to the unchanged level a couple of times. That didn't work. We saw more selling, and then we closed off of the lows overall. Here's the performance of the different indexes over the past week. The NYSE had the least amount of loss, followed by the Dow, which was down almost 0.5%. The S&P was down 0.77%. The small caps had a little bit of trouble by going down 1.2%. The mid caps were down 1.36%, and what's really been getting hit hard lately is the Nasdaq and the Nasdaq 100, with the Nasdaq 100 down 2.92% and the Nasdaq itself down well over 3%. Here's just another representation of how things performed in the week. The Dow was down 0.2%, the Nasdaq 1.5%, the S&P down 0.2%, and then the small caps, measured here by the Russell 2000, down 1.3%. Our different sectors. The sector that had the most weakness was the real estate sector. They were down 3.8%. Discretionary, which has been getting hit really hard, was down 2.9% for the week. Staples, which also have done pretty well lately, they were down over 1%. Tech was down. The areas that had some strength were the energy sector at the very bottom. It was up over 10% on the week. Utilities, which have been doing pretty well lately, they were up 1.33%. And financials, which have been seeing some overall weakness, but they were up slightly on the week. And here's just a representation to show how they performed during the week. With energy doing the best, way over on the left. Way over on the right, we have discretionary, which was down over 8% Monday through Friday. We also had the current market valuation charts update, and they're currently saying, according to their model, that we are fairly valued. We're not too expensive, not too cheap right now, but this is a matter of opinion. This is just the way they do this. You might look at some other things and reach some different conclusions. Here's all of the charts, where over on the left-hand side, again, their yield curve is different than the yield curve that a lot of other folks use. They use the 10 to the 3-month, and that never went inverted. So it's making this model look much more positive as far as not showing signs of a recession. And these charts behind the text, they're live charts, so they really update with what is measured by currentmarketvaluation.com. Then we have the Buffett indicator. It's still saying that stocks are overvalued. That's taking stocks and comparing them to GDP, where we had gone extreme. Well, we're coming off of that. We're down into the yellow area, but we're still overvalued. The PE ratio is also overvalued, where it had been extreme, but we're coming down into the yellow area. Interest rates, which still continue to be historically low, that is more fairly valued. Where margin debt, we finally had an update of that section at the end of March. It just shows that margin debt has been decreasing recently. And you'll see that when the market's really going up, people will buy stocks by borrowing money. When the market starts to have some trouble or gets really choppy, people will stop buying on margin or get rid of some of the assets that they have that they bought on margin. Or if we see some big declines, they might have a margin call and they have to get rid of it. Then the mean reversion, which is how the S&P is compared to the mean price over a period of time, we had gone extreme positive, getting way, way overvalued. Well, we're coming back down off of that, but we continue to be overvalued. As far as sentiment, after Friday's session, we're getting down more into the fear range right now. We're at 31. When we drop below 25, that's showing real extreme fear. And when it gets to that level, that's when we use it as a contrary indicator. When everybody's freaking out, we're looking to buy. When we get all the way over to the right, above 75, when everybody's euphoric about things, that's when we're looking for chances to get out or to sell. We're seeing an increase in fear, but we're not seeing it at a real critical mass at this point. This just goes back and shows how the chart is updated over a period of time. Another thing that was released is the Rydex bear to bull ratio. This takes a measurement of those that get into the bearish funds that go up when the market goes down versus those that are in bullish funds, those that go up when the market goes up. And it did increase to 0.10 in the past week, but we have spiked higher than that. So there's still more room for this to go up, but we're starting to see a lot more fear by these mutual fund investors. Also, the American Association of Individual Investors. Last week was one of the most extreme readings we've seen in a long time. Well, last week also gave an extreme reading. We're at minus 26, which is better than it was a week ago, but still extreme negative. We tend to use this as a contrary indicator because a lot of individual investors, they tend to react to what's already happened instead of looking forward to try to anticipate what will happen. And a lot of these folks might make their decisions in the evenings and on the weekends. Then they react to what has already happened. And that's why we get such a low reading in this survey. Also, the VIX, it actually declined a little bit for the week. The top line chart just shows where on a closing basis, the VIX did increase. This measures fear. The higher this goes, that means the more fear there is. And the bar shows that we closed well off the highs. The VIX had been a lot higher earlier in the week, only to come back down as of Friday's session. The Ulcer Index, after declining, and this also measures fear, it turned back up slightly. If you look at the daily charts, we're seeing pretty severe fear right now. It's really starting to top out, and that is then coming through over into the weekly chart as well. One thing that we like to look at in these videos is the Financial Conditions Index. And looking at this chart, times when this really spikes up, this was the financial meltdown of 2008. Then you had all the problems going back into the 1970s and 80s. So when this really spikes up, that means that the financial conditions are not all that good. But if you look at where we're at right now, as of the end of April, we're going up, but we're not above this black line. So the folks behind this are not necessarily seeing a lot of problems right now, which is producing some contradiction within the markets because we're getting some economic reports suggesting that there could be problems, but looking at this, it's not registering any problems currently. Another thing that we watch is the credit spread. The spread between really risky loans and those loans that are not as risky. When we hit really difficult times, this number will really spike up. Well, you look over on the right-hand side, and we've actually been flat. Also, we have what's called the NAAIM Exposure Index. This measures active money managers, whether it's in a mutual fund or in a hedge fund or some kind of a actively managed portfolio, where when this rate goes up, that means these managers are willing to get more into riskier assets because they produce a higher return when you're correct. Well, in the past week, we saw an increase, and I've kind of changed how this chart looks. On the top is the NAAIM number, and on the bottom is the S&P. As far as Fed Watch, we won't do that as much right now because we still have quite a bit of time until the next meeting. But as of Friday, there's an 82.9% chance that after the meeting coming up in the middle of June, that we will be at 1.5 to 1 3/4 as the Fed funds target rate. We're currently at 0.75% to 1%. So that would be another 50 basis points added to the Fed funds rate. And here's the historical chart that just shows how things have jockeyed around with their probabilities. Then looking out into the July 27th meeting, there's currently an 82.7% chance that we'll be at 2 to 2 1/4 after that meeting. And here's the corresponding historical chart. Another thing we like to keep an eye on is the Fed balance sheet. When they're in doing quantitative easing, they're buying corporate bonds, they're buying mortgage-backed securities, they're buying treasury bonds. Their balance sheet will really increase. Well, it was announced this past week that there will be a tapering plan, and they're going to start either letting some of these mature and just go away, or they're going to actually start selling them. What we should anticipate over a period of time is the number on the right should start to decrease, similar to what we saw back in 2018. As far as breadth, we're pretty negative right now. We're declining based on price, and we're below the moving average, and we're also declining based on volume. And we're seeing a bit more weakness with the volume since the red line, the trend line there, is actually going down. It was flat for the last week, but overall, we've seen a real decrease in how volume is behaving. Another thing that we measure is the advanced decline ratio. We take a 19-period exponential moving average, plot that, and we also plot a 39 exponential moving average. And when both of these are going down and they're below the zero line, that means we are negative overall. Another thing are new highs and new lows. We're seeing on a weekly basis a few new highs, but we're seeing a real expansion of new lows. And then we take a 4-period simple moving average and measure that right in the middle of the chart, and that's declining. And then we have a 10-day moving average of the high-low differential, and that is below zero and continues to decline. So that's also negative. Accumulation distribution. Accumulation is when you buy, distribution is when you sell. When this line is going down, that means there's more selling than buying, and we're below the moving average. As far as our trend, it is getting a little bit stronger. The black line is going up with the ADX, and I have a moving average plotted on there as well. But when the red line is on top, that means sellers are in control. Even though we saw a bit of a decrease in the past week, we're also seeing a decrease in buying. That's the green line down below. Our Arun is also showing sellers are in control. We're pegged more near the top with the red line way over on the right-hand side, where the green line is declining. And when you take those two together, we have our oscillator on the bottom, and that just shows that we are declining week over week. So that is also negative. The mass index, we're waiting to see if this is going to generate some kind of a signal. We've been able to go above 27. That's the first part of the signal. And then if it drops below that dashed red line, then that will be signal number 2, and that will tell us that something should happen in the market. We don't know if it's positive or negative. It's just that something is building up, and we should oftentimes see a significant move one way or the other. We're also waiting for any kind of a signal on the daily chart, and that hasn't happened yet. Long term, the decision point scorecard after Friday just shows that we're pretty much neutral to down on every different time frame. Then our pivot points, you can see the bar for the latest week. We really didn't change all that much since we were only down 0.21%. We're still above the S1 support level, but we're below the pivot. So that's negative overall. And even though we saw a bit of a decrease in volume in the past week, we are still above average. We are below the 50-period simple moving average. So that just shows that we're more negative on a weekly basis. And our long-term trend, we had a recent death cross, and we're seeing a real decline right now. So this is also negative. The bullish percent index, it didn't change all that much for the week, but it's below the 50, so that's negative. And also looks to be declining, even though it was little changed in the past week. The Chaikin oscillator, this is one thing that it's kind of interesting. This is getting pretty extreme negative. And this might suggest that either we're at or getting close to a bottom, according to this indicator, where we eventually want to see that turn up, and with some other things coming together, might see some kind of a bounce. But there's really no evidence for that at this point. Another thing is the Chaikin money flow. It declined over the past week, a little bit less than the previous week, but it still declined. The force index, it's kind of the same thing. It's negative, but it actually advanced a little bit, but overall is still negative. The McClellan oscillator, it's actually bouncing up a little bit, but it's still negative. It's advancing, but it's below zero overall. The summation index, it's declining based on price and below zero. And it's actually advancing a little bit based on volume. And sometimes this has been kind of a nice little leading indicator when we look at the volume. Sometimes this will start to turn up shortly before we see a turn up in prices. The top part of this chart, yeah, it's negative. We're declining. The bottom part could potentially be something positive. All of our momentum oscillators on the weekly charts, they continue to decline. The PMO, the oscillator on the top, that is declining and in danger of dropping below zero. Based on price, we're showing a decline. Based on volume, we're also showing a decline. The percent of PMOs that are actually rising, they became extreme negative recently and now is bouncing up a little bit. So that could potentially be positive. We're seeing the PMO buy signals, they were extreme negative and starting to bounce up. That's the red line. But the PMOs that are above zero continues to decline. The RSI is negative because we're below 50 and we're still declining. Special K, still looking okay, but starting to roll over. This is a longer term oscillator that we use to measure the trend. And it takes a lot for this thing to really change, but we're seeing a slight decline lately. The STO, or Swinland Trading Oscillator, it's been actually kind of clever on the daily charts, and it could be on the weekly charts. It's been leading us a little bit. Even though we've had some down days over the past week, it was going up. And then when we had a real strong up day, it started to turn down. So it's been kind of interesting to watch that. But right now, we're looking a little bit better based on price and a little bit better based on volume. Stoke RSI is extreme negative and pretty much as low as it can go. So we're extreme negative that way, which could potentially be positive to look for some kind of a bounce. Williams percent R, it's extreme negative as well and trying to bounce up slightly. The vortex indicator is negative, even though we're seeing the red line declining. That's selling. We're seeing a bit of advancing with the green line, but we need those to cross for this to turn back positive. Ultimate oscillator continues to decline and is not extreme negative right now. Money flow also declining below 50 and not extreme negative. Bollinger Bands, we're not giving any kind of an extreme reading at this point. This really gyrates around when we get outside of the Bollinger Bands. That just means that the market's moving really fast, either up or down. It advanced a little bit in the past week, but is still negative overall. The KST has been trailing off now for quite a while. It's kind of one of those oscillators that if you really paid attention to it, you would have missed pretty much the whole move in 2021 where we were going up because it was going down. So we're seeing a negative divergence here. And I don't really pay attention to this one as much just because you can see how it got things wrong. The PPO, or percentage price oscillator, continues to decline. Rate of change, looking back on 1 week, actually advanced slightly, but we're still negative because we're below that dashed line. Looking back 50 periods, we're slightly negative. We're below the dashed line, even though we turned up slightly. And the Copic curve, this is another signal that we're waiting for on the daily charts. If this can turn and go back up, this is pretty good at picking market bottoms, but it hasn't generated a signal on the daily chart, and it's pretty much flat on the weekly chart. Our different charts, the Heiken Ashi is looking more negative. The Kegi is negative because the bar is red. The Renko is negative because the blocks are red. No new signals on the point and figure chart. Nothing drawn on this chart. We're still having a chart pattern on a weekly basis of a double top breakdown, and that was generated back on April 11th. But we're just waiting to see, can price move to generate any new X's or O's from this point? 3-line break continues to be negative. Our different trading systems, the Elder system on the S&P is negative with a red bar. The parabolic SAR system, the dot is above, so it continues to be negative. The broad market with the Dow just along the top, it's been holding up better than some of the other indexes. The transports have been kind of going sideways lately. The utilities have been doing quite well. Saw some recent weakness, but had a fairly good week this past week. All stocks, which looks at U.S. stocks as well as international stocks, were in a pretty solid downtrend in this ETF. Mid caps, and you're going to hear a lot of the same thing over and over, death cross and dropping. Small caps, death cross and dropping. The Dow, death cross and not dropping as much, but still negative. The Nasdaq, death cross and dropping. Nasdaq 100, death cross and dropping. NYSE, same thing. Although it's holding up a little bit better, this is a more broad-based index, and if this really starts to go down, we pay attention to that. Wilshire, also broad-based, death cross and dropping. FANGs, really having some trouble right now, down over 2% for the week, almost 2.25%. ARK, really having a lot of trouble as well, in a definite downtrend. These are the growth stocks, and value has been performing better, but we see our real gains in the markets when the growth stocks do well. The dynamic software Intellidex index is also negative right now. These are the 30 biggest U.S. software companies. And then this is one of the scenarios that I've been watching on the daily charts, is a lot of times when the staples to S&P 500 ratio, when that spikes and then starts to go down, a lot of times that will mark a bottom in the S&P. It was looking kind of viable earlier in the week when we saw that big run up on Wednesday, but then with the declines on Thursday and Friday, it's not looking as positive. Now, this is a daily chart. This isn't a weekly chart that I have here, but we're trying to see if we can get some kind of a signal from this. This is a little bit tricky because about the time we think there's a spike, then we turn out to be wrong. So we kind of have to watch for this to develop, use it as one of our signals, and then compare it with some other things that we look at to see, is this a viable signal? That's why I have a question mark here. As far as the broad market, the CRB was up almost 1% for the week, and this is where we're getting a lot of our inflation data from. Gold was down 0.84% on the week, but it's still in an overall uptrend. Silver, kind of starting to see a little bit of weakness here. It's been gyrating all over the place. It was down 1.8% for the week, and we're trying to cross with a golden cross, but now prices dropped below both of the moving averages. So that's a little bit more negative, and we're getting some mixed signals there. Oil finished out at 109.77. It's been in a strong uptrend overall, but it's been chopping around more lately instead of just spiking higher and higher. But that could change at any time. The dollar's still been doing really well. We closed at 103.69 on the weekly chart, and we're seeing like 20-year highs or something in the dollar. Hasn't been this high in quite a long time. Relative studies, bonds are underperforming stocks, so that's why you see this declining ratio here. Stock market on a monthly basis have been really outperforming bonds lately, and we're actually breaking out to the upside. Here's an intermarket analysis chart, which just goes back to the beginning of the year, and it just shows how oil has been performing the best. Gold actually dropped below the dollar, with the S&P declining as well as bond prices. The gold to US dollar ratio is declining because the dollar's going up pretty fast and gold is kind of chopping around right now. We're not seeing any kind of a breakout in gold. The gold to the S&P continues to be positive. The low volatile stocks compared to the SPY also shows that we're breaking out even though we had some weakness over the past week. The growth to value ratio just shows that growth is underperforming, whereas value is outperforming. The NASDAQ 100, which are mainly growth stocks, are really underperforming those in the S&P 500. And the biggest stocks in the S&P 500 continue to underperform those in the S&P 500, even though we had a bit of a bounce this past week. Discretionary, the things that you kind of want to have but don't have to have, they are really underperforming staples, the things that you do have to have. And then energy, which has been doing really well, has massively been outperforming tech. So what's our outlook then for the upcoming week? The major economic reports that are going to come out. Wednesday is a biggie. We're going to get the consumer price index, and that's where we get the inflation number from. So if you watch any of the daily videos, I'll be discussing that after Wednesday. On Thursday, we also get a very important report. That's the Producer Price Index, or PPI. And then on Friday, we get the University of Michigan's Consumer Sentiment, the preliminary reading. How are people feeling about things? And then I go into some discussion about that. So what are we watching? Of course, the technicals. That's what we always watch, or the charts. Inflation and interest rates continue to be what the markets are really focused on right now. Of course, the geopolitical concerns. We have the Russia-Ukraine situation. And one thing I understand is that May 9th, which is Monday, that is a very important day in Eastern Europe because that's when they mark the end of World War II. I've heard some rumblings in some of the sources that I listen to and pay attention to that something big might happen. Now, let's just hope that's just some kind of a rumor and it doesn't turn out to be anything. We also have the continuation of the supply chain issues because China remains on lockdowns and that's affecting their economy, which could eventually come over and affect the U.S. economy. Oil, we have to always keep an eye on that. Any kind of speeches that people from the Fed are giving, earnings that are coming out, and then I'm adding Japan to this list because I'm seeing some real concerns right now about that. We just want to watch their bond market because they're running into some trouble. They backed themselves into a corner, which could mean that they have to start selling U.S. bonds, and they are the biggest owner after the Fed of U.S. bonds. When you sell, prices go down. That means interest rates end up going up. And so that could have a real influence in the future with the U.S. economy. What are our different scenarios? The first one, yes, we are going down. That's why it's in yellow. What's going to keep things still going down? If we see interest rates continue to rise and these inflation fears. Earnings that are coming out, any Fed speak that I mentioned before. The technicals, we are negative. And right now, we're not necessarily looking oversold across the board, but we are seeing some oversold indications, especially in the short term. We want to see more extreme readings as far as sentiment and some of our other charts before we say, yeah, the market's oversold. Everybody's pretty much declared the stock market dead. That's when we start looking for a bounce. We're not quite there yet. What can help the market go up? The possible positive scenarios that I go through and I kind of mentioned here in this video, where we're looking for the mass index, the Kopik curve. the staple spike. The idea that after we've had an inverted yield curve, sometimes that produces some really strong advances in stock prices. We haven't seen any of those scenarios develop yet. The technicals, they're looking pretty bad right now, but we may get some support from some pivot levels, and we did bounce off of support on Friday, pretty long-term support on the daily chart. If we can stay above that, that could be positive. Sideways, we're not in a sideways market right now because the ADX is above 20. It's sideways to declining slightly, but it is showing a negative trend overall. So thank you very much. I hope you have a wonderful week, and I will prepare the next weekly video next weekend.